That's a scary laugh in case you were curious. Today we're going to be going ahead and doing a spooky, super spooky edition for October of Do Not Buy These Stocks. And I mean this, don't buy them. I got a suite of 3 stocks for you today that I consider not buyable. Do not buy them. We're going to go right into it. As you already see number 1 on your screen right now. General Electric, or GE. So GE is a very large corporation, appliance maker. You definitely know GE, probably pretty household name. But why is this such a garbage stock to buy? Well, first I want to paint an image, which you can see based off this 5-year chart. Things are looking a little bit rough. So in 5 years, it's lost 64% of its value roughly. We just kind of want to look at what led to this. You see a lot of this decline started in 2017. Well, what happened in 2017? We're going to go ahead and take a little track record of what's going on in a company-wise in terms of their dividend, because this is a big portion of their business that led to this fall. So we see from 2013 we're going upward here and increasing annually that dividend, right? There's an annual increase in dividend until we reach, day after Christmas, huh? You're going to give us a lovely Christmas present of a 50% decrease in dividend? Thank you. What a great Christmas present, General Electric. You're treating us all very well. Let's keep going. Our next Christmas present is going to be a 1 cent dividend. This is not a typo. Are they joking? 1 cent? GE, that's a slap in the face. This is a company that was well known, yielding around 3 to 4%. Now you're going to tell me you're going to pay me 1 cent per share? Why? What are you doing? There's no point. It's just awful. It's ugly. That's just ugly right there. And this has caused the stock, obviously, to get hammered because the investors that were in this for dividends all got out. And it's smart because this business, it's hurting right now. It's hurting a lot. The reason they cut this dividend was to work on debt. And debt is something that they need to work on. Let me tell you that. So, as a company, we'll go ahead and take a little bit of a look at what they're working with here. Lovely profit margin of negative 15%. Obviously lovely. Trailing 12-month revenue of $120 billion, right? That's pretty good. Gross profit of $23 billion. Wow, you make some money. Okay. Quarterly earnings growth year over year, minus 84%. We'll forget about that. We can forget about that. Total cash of $13 billion on hand. Okay, the balance sheet has a little cash, right? No, it doesn't. Total debt, $109 billion. I'm not making this up right here. $109 billion in debt. So they cut their dividends so they could pay this debt. What they're going to have to do is sell the whole company. My gosh. $109 billion. That is a ridiculous amount of debt. And I would never play around with a company with that kind of debt. It's ugly. Because where's the plan to get rid of it? They have no plan to get rid of it. There's no way for them to get rid of it. $109 billion? If this is accurate, and in the past 12 months they've made $23 billion, you're going to tell me, without any other expenses, just the profit they made, right? They're going to take 5 years to repay that debt? 5 years before they get out of the hole? This is a company that doesn't know where they want to be. They're doing a lot of redirection, a lot of change in management, because they don't know how to make things work right now. It's a failing company, and they're going to work on fixing it. I know it. But it's something I would not touch right now. Would not touch it. I mean, there could be a 900-foot pole, and I wouldn't touch this thing. And even we go to look at their revenue here. Where's the growth? Where's the growth at? I don't see any growth. Just looks stagnant. Operating expenses, I mean, what's going on here? Stagnant. Profit decreasing. Profits decreasing. Stagnant growth. Net income negative. Negative net income. You're losing money. You're not making money. So how are you going to pay back that debt? Someone's got to tell me. Someone's got to tell me, because I don't know. Because this, I'm scared. I'm scared of this stock. It's garbage. This is a stock that's going nowhere in terms of price. Nowhere in terms of price. It's not going to go anywhere. I'm just going to tell you that right now. It's going to be stagnant unless they can find a way to actually turn around that business model. So for now, I would say stay away. Do not buy GE. There will be no growth. You're not getting dividends. Besides 1 cent. Don't mess around with GE. Next, here's a contentious one. Shopify. Spooky, huh? $300 stock, I'm telling you not to buy it. What's that about? I have to preface this with the fact that I don't dislike the business here. The reason I'm going to tell you not to buy this stock is 100% in terms of valuation. This stock is priced absurdly high. And I'll show you exactly why that is. This is a 5-year chart, and you see pretty steady growth over 2015-2019 period, right? Pretty nice growth, right? 440%, and then parabolic. Look at it go up. So in the past year to date, the darn thing's gone up 200%? Are you kidding me? You tripled your money? Well, you shouldn't have. You want to know why? This stock's overvalued. And it's on a downtrend now. Now, part of this downtrend could be seen due to this recent capital raise. So they went and offered 2 million shares out there, 1.9 million shares, in an effort to get what looks like here $603 million. So what are they going to do with that money? That's the concern for me. So you never know when a company's selling their shares, because that devalues the shares a little bit, you know. That dilutes the shares and they're worth less. And that's why you see a price decrease. So they're doing this to get money, and I don't know whether it's they're making their balance sheet look better, or if they're trying to maybe go ahead and use this money to pay off some investments, to go ahead and maybe purchase something for growth. As you see here, they give an expectation here, which, you know, I should have read before I just made the statements, but I made the predictions before they did, even though they already did. So we'll see what they use it for. I don't know if they're going to be planning on buying or investing in another company. We'll see. I think it's a balance sheet stuffer, personally. So if we look at Shopify here, a forward PE of 321. Do I need to tell you it's overvalued or not? I mean, it's overvalued. A market cap 35 billion. And why do I think that market cap of 35 billion is absurd? Also, price to sales of 27. Anyways, why is that market cap absurd? First off, negative profit margin. The market cap is absurd because this company, in the past 12 months, trailing 12 month, $1.3 billion in sales. That's it. That's all that they made in revenue. And they're marketed at a market cap of 35 times that amount? How does that make any sense? I mean, this is why you get a multiple here of 321. This company is so highly valued. It's extremely overvalued. Only $2 billion in cash on hand even. This stock is $300. What is going on? Relatively debt-free. I'll give him credit for that. That's what I can give him credit for. A lack of debt. But why is this so highly valued? This is why I'm telling you to stay away from this stock. It's the value. I don't think the business is bad. It's a company that's growing revenues pretty rapidly. And you can see from here, over the past 5 years, consistently growing revenues. 20% at a time even, 20, 30%. What I don't like, though, is the fact that, first off, net income, negative. Not good. I don't like money losers. I like the fact that you're growing revenue, though. So I'll give you that. But what I don't like about you is how highly valued you are. This company is going to need to lose at least $200 per share before I'd even consider getting anywhere near it. It's so highly valued that if some sort of bad news came out, significant bad news, this stock's going to come tumbling down. And I just wouldn't be one around there for the fall. I'd stay away from Shopify right now if I were you. That's my opinion. Our last spooky stock is pictured on your right. Groupon. I found another picture of Groupon here. Another picture of Groupon. And finally, a clip art picture of Groupon, Oh, sorry, that's a garbage fire. Sorry, that's not... Wrong picture. It's Groupon. This is Groupon. What am I talking about? This is for the life of the company here. Why is Groupon a garbage company? I mean, do I need to say? IPO somewhere around $28 a share. This company has since lost 90% of its value since IPO. And this is over a 6-year period, 7-year period. That's ugly, right? That's ugly. So what happened here? So obviously back in the day, a lot of people use Groupon. It's kind of like, as the name states, it's a coupon service. It's online coupons that you can use. You purchase them and you get better deals on certain things, whether it be events or products, whatever it might be. People don't use it anymore, though. This company's garbage because, first off, an EPS of 1 cent per share, no profit being made, and revenue declining 13.7% year over year. So if you had any idea if people weren't using it anymore, they're not. They're not. And we can see that. So look at the revenue trend here and how ugly it is. Let me just look at this revenue trend to the right. Yeah, that's right. This revenue trend is awful. Decreasing revenue every time. Net income. Where's the net income? They've lost money over the past 5 years. Lost a lot of money over the past 5 years. That's ugly. I don't like that. Decreasing profits. There's nothing here that makes me excited, right? What's going to make me excited here? The current PE of 220? I mean, it's not a negative PE. I mean, it's positive, right? A profit margin of 0.32%? That doesn't make me excited. Revenue of $2.5 billion? I mean, that's impressive. But, yeah, don't forget about that revenue decrease. Quarter over quarter, year over year. And what the most ugly part about this garbage company is, they only have $600 million to their name and $400 million in debt. I mean, that's concerning to me. I don't know if it's concerning to you, but I don't consider it exciting. One thing to consider, which I didn't with the others because it's not a significant factor, 23% of these shares are held by insiders. So these are people within the company. Once they bail ship, who's going to buy these shares? They're not. These are going to be devalued, This company's just set to lose more money. I don't know why you would invest in Groupon. There's just no reason to invest in Groupon at this point. There's no reason. You might as well go to your local dumpster, light a match, put in some timber, and watch it go. It's as good as buying Groupon stock. Don't mess around with Groupon. It's spooky. Don't forget, do not buy these stocks.